One of the biggest concerns that you might have leading up to retirement, and this is probably at any age, is, well, the question is my nest egg, my long-term life savings, safe? And there's a whole heap of things that come into this question. It could be, is it safe from, on one extreme, fraud, unscrupulous behaviour? Is it safe on the other side? Are we investing in a quality company or a ASX 200 index, which is pretty good? Is it safe? Well, yeah, but then there's a volatility in market and risk. So there is this big chasm of daylight between these two posts, right, Vince?
That's right. And ultimately, 100% safe
still has a risk.
Well, it does have a risk, but it also means that it's highly unlikely to meet your goals.
Yes.
Like the safest thing is to stick it in the bank, at least if it's up to $250,000. The government will come and, should the CBA fall over, highly unlikely, but Westpac came very close in 1991.
Suncorp in GFC came close to running out of cash as well.
Yeah. And so it's, as in you'll still get your $100 back, but inflation's whittling it away every day. So the odds of you achieving the goal you want for the $100 is very slim over long periods of time. So you need to look at what you mean by risk in that context. And I always think about risk in the context of what's the probability of me achieving my goal?
Yeah. So in the Retire Right Facebook group, and if you want to join the Retire Right Facebook group, when we say on the application on the way in, where did you hear about the group? Just put, I heard Glenn and Vince on episode 3 and then XX, whatever the number is, just so we know that you are a real person. You have heard us on YouTube or the podcast. But
Hashtag not a bot.
Not a bot. Angela in the Facebook group said, maybe a stupid question, and it's not at all a stupid question.
Well, I mean, the only stupid question is the question you don't ask.
Exactly. When you retire and have your super money, where you place it with an advisor or a super fund, how do you ensure it's safe? Not like the poor people that you see on A Current Affair who have had funds drained by some scumbag. And just a bit of context for this situation, just trolling through the comments, and it was a popular post in the group, I think in the view that the poster was asking was they have a self-managed super fund and they have a commercial property within the fund. So they may be considering selling that property, which, you know, when you sell a property, Vince, you end up with cash at the other side of the transaction.
You do.
What do we do with that money, and is it safe? So this episode of Retire Right, we're actually going to cut it into 2 bits. The first bit, Vince and I, we're going to talk about just the lay of the land in terms of the structural relationship between self-managed super funds, financial advisors, investment products, and how that works in a normal, I'll say normal world. I won't say perfect world, because the normal world, most people aren't getting screwed, but unfortunately the ones that get taken for a ride, they don't seem to lose just 1% of their worth. It's a full flush.
Yep.
And then the second...
Much of which comes down to lack of diversification.
Yes. And then the second part, we'll talk about some red flags to look out for when investing in general or super and engaging with a professional. So my name's Glenn James, joined by Vince Scully from Life Sherpa, regular wildlife around these parts.
G'day, Glenn.
Let's do a podcast.
Glad to be back.
This is a podcast that will help you plan and execute one of the biggest moments in your life. That's retirement. You'll learn how to set up your finances in a way that benefits you, your lifestyle goals, and keeps you in the know within this complex world of money and investing. Your host is Glenn James, former financial advisor, author, and host of the popular Money, Money, Money podcast. Glenn is joined by experts in various fields around the topic of retirement in Australia. Any advice in this podcast is of a general nature. Full details are in the show notes of this episode. You only retire once, so retire right.
Vince, what about you talk to us about, we'll just forget about this self-managed super fund thing for a second.
Yep. Because that does change the complex.
Yeah. Let's talk about run-of-the-mill big super fund that you see on the TV or that a lot of Australians have. So just a industry fund, a retail like your AMPs or your MLCs or your BTs.
So a super fund is really a bundle of 3 different services. You've got the trustee services, and trustee in that sense means someone who owes you an obligation to look after your best interests and prefer your interest to theirs. And there are 165 of those, give or take, and they hold a licence from APRA to run a super fund. And they're the people who's responsible for putting out the PDS, holding the money, getting the accounts done, and they're the ones who'll get smacked over the head by APRA if anything does go wrong. They then need to put together a portfolio. So portfolio management is the next set of services.
Yeah, so we've got the trustee, then we've got the actual, would you say, investing?
Yep. So the portfolio management, which is deciding what it's going to be invested in.
Yep.
And that is the thing that says, look, I'm going to create a balanced option. It's going to have 20% in infrastructure, 20% in real estate, 40% in Australian shares, et cetera, et cetera. And they're then going to engage with external fund managers to actually put that money in place. So most of the big funds that you'll be familiar with don't actually manage very much money. So House Plus, for example, doesn't manage a cent of money in-house. It's all managed by external managers. And that's the third piece, the actual asset management. So trustee, portfolio manager, asset manager. Some funds like PSSAP is
The government?
the old public sector super is statutorily barred from managing money. So the law that set it up says you are not allowed to manage money in-house. So all
You've just got to make the decisions.
Which
and be a
manager to
good
buy.
Trustee.
That's right.
And I think it's a really good, an important point to make here, Vince, that in this trustee relationship, Vince Scully or insert Mary or Joe, whoever
as
out
the
there,
member.
as the member,
Yep.
you technically, if you want to, like, that super fund money isn't really yours, quote unquote, in terms of an estate asset.
Correct.
It's held in an external third party corner of the world, which has a trustee, which is insert your big name super fund,
Yep.
for the benefit of Vince Scully, Mary, or Joe.
So as the ATO says, it's your money, just not yet.
It's only your money when it lands into your bank account.
So those 3 structures, those 3 services goes to make up a super fund. Now, for many people, particularly people with small balances, they're going to buy all 3 of those from one entity. So think House Plus, Australian Retirement Trust, Aware. Who else has paid you money to be on the show?
Gosh. Aware have.
We should give them all a shout out.
Yeah, ART have sponsored this. We've done some work with UniSuper.
So all of those, bundle those 3 services up into one PDS effectively that you sign and your employer gives them the money. You can choose to unbundle those services. So a wrap account, for example, where the wrap or the trustee, the issue of the fund, so for BT Panorama, that's Asgard Super. For Macquarie, it's some sort of Macquarie Investment Management, but it's one of the 165 super fund or RSE, registrable superannuation entity.
Now, if you want further details on wrap accounts, if you've just stumbled over this episode, we'll put a link in the show notes and description on YouTube to the episode that we did a deep dive on wrap accounts.
Excellent.
So we don't have to recover that ground.
So if you do go to wrap, you're just buying from a different trustee. Many of those are brand names that you might not recognise because they don't spend $45 million a year marketing, but they are just as big. So of the top 10 funds, of the top 3 RSEs by assets, you'll find 3 of the top 10 are brands that you will just not recognise. And so in that model, you're often going to buy the portfolio management piece from your financial advisor, or in some cases yourself, and the underlying asset management will be quite often, all those big brands like Vanguard, BlackRock, whatever the fund managers you're familiar with. And in a wrap, the trustee, their role is about making sure the right products are available on the menu. But if you tell them that you want to invest in the Glenn James active fund, as long as it's on the menu, they will follow your instructions. They'll often put guide rails around it, so no more than 20% in one fund.
Okay, and that's a really good example. So, for example, people say with insert Australian Super, Aware Super, ART, CBUS, or your super funds, why can't I buy Bitcoin with my super? Well, the trustee have a responsibility to manage your money for the benefit of you for retirement.
And they've got an obligation to act as a prudent trustee. So assuming they did buy Bitcoin as an example, and it disappears overnight, then they could be held liable to have made a stupid decision.
And I will say some of these other new entrants to the super world, such as Superhero, where they let you pseudo have your own vibe and choose your own investments, there is still a trustee behind the scene, and you'll find that maybe 40 to 60% has to go into a bread and butter diversified portfolio.
That's right. And that's why Choice Plus with Host Plus, for example, says you must keep 20% in a standard, one of our standard options. You can put no more than 20% in a specific ETF.
Now, some people
and there's only a list of 29 ETFs you can invest in.
And they're not going to let you buy the 421st size company on the ASX.
Correct.
So
that's them exercising their prudent trustee responsibilities to protect you from yourself.
Yes. So that's kind of the lay of the land. So, and if we kind of swing back in and out of this question, most of the big super funds that you hear in terms of all the big ones, and even the ones that, particularly financial advisors who I hang out with, and you and the financial advisors that go to the FAAA conferences and all that.
Like even my financial advisor does that.
Yeah.
Which, heads up, is not me.
Is, most of the stuff that they recommend, they're going to be quote unquote safe.
Yeah.
From a fraud type thing.
Yeah, and that's a good point. Just talking about safe and super funds, there is a distinction between the regulation of a super fund and the regulation of a managed fund. So if you contrast money...
Or an MIS, which we can get into.
Or an MIS, yeah. So if you've got... so the distinction between buying Vanguard Super, as an example, and buying a Vanguard managed fund, Vanguard Super, the super fund trustee, and they're one of these 165 RSEs, they're regulated by APRA. And APRA stands for Australian Prudential Regulatory Authority, and the emphasis being on the P for prudential. So APRA cares what it's invested in. So they're looking at the security stability of the financial system, and they want to make sure that it's invested prudently. ASIC, which regulates managed funds, is not a prudential regulator. Their job is to make sure that Vanguard managed funds follow the rules, do what they say they're going to do in the PDS, and are appropriately licensed and audited and all those sort of things. So they're two very different roles for the regulator. And so a super fund is a much more strictly regulated entity than a managed fund. And self-managed super funds are not regulated by APRA. They're regulated by the tax office. Again, completely different. That's a pure compliance focus.
And, well, just on the self-managed super fund, effectively what you are doing is you are stepping in and doing what it says on the box, self-managing your money, and effectively you will be the trustee, or a company that you're a director of will be a trustee of that money.
And you will usually be buying managed funds rather than superannuation products.
Yeah.
So
yeah, and so in the kind of in the normal investment world, if we call it superannuation money, which is your big funds and the money goes into super, you might log in and be able to select, I want an ASX 200 investment option within my super fund. I can buy that same investment option in ordinary money in my own world, outside of super. But if I've got a self-managed super fund, that super fund can buy that thing that's ordinary money. Correct. And the minute that super fund buys it, it's considered in superannuation.
But it doesn't get the benefits of APRA regulation. It doesn't get the protection of what used to be the Superannuation Complaints Tribunal, and is now AFCA. And it's just regulated to a completely different standard.
Yeah.
So that's an important distinction. And certainly a lot of the stuff that we see where there is losses of money, it's not as a result of the behaviour of super fund trustees, which I guess we can come back to, because to my mind, I think there is only one super fund failure since, in the modern era, as they say in tennis, but since 1991 when the Superannuation Industry Supervision Act was brought in.
But that's not to be confused with individual product failures that can be purchased within super
and that's
environment.
Yeah, and that was sort of the point we'll get to at some point. And that was Trio or Astara, which fell over in 2009. I think it was 2009. Largely fraud related. The members of the super fund lost about $70-something million, which out of the $4 trillion of super assets is a really small sum of money. I'm sure every one of them felt every dollar of that, but in the scheme of things, that's a relatively small number. And all of them were made good through what was then the Superannuation Complaints Tribunal, and that was funded by a levy on every super fund. The people who did lose money were the people who'd invested in the underlying managed funds, mostly self-managed super funds.
Through ordinary money, quote unquote.
Yeah, and they don't get the coverage of that levy. So they lost, I think, about $100 million between them. And that was outright fraud. The trustee of the super fund arguably should have done more due diligence, which is easy to say in hindsight. It certainly didn't make the approved list of the investment fund I was running at the time.
Yeah. A question and more of a comment. People might be thinking, well, I've got my super with CBUS, ART, bloody Australian Super, Aware Super, all that stuff, REST. Well, what if REST goes under? And I think just in that trustee box the first kind of pillar, there's almost two entities. There's an entity that is the employer of all the people in the call centre who do the paperwork and manage the fund, but the actual wealth is in a separate entity, which is the trustee.
That's right. But you do raise a really interesting point when you come to member-owned funds, and this is something that gets lost in the run only to benefit members propaganda that a profit is payment for risk. So if you are in a mutual fund, which many of those larger names you just mentioned are, if the manager has a problem, like they overrun on a IT system development, which they have done in the past, or the money they spend on marketing doesn't bring in the new members they think it's going to do, or something from an operational perspective goes wrong, you as a shareholder in that company,
aka member of the fund.
By being a member of Host Plus, you are exposed to the operational activities of Host Plus, the manager. Now, that's not a huge risk.
But it's just a fact.
But it's a fact of life, and it's a consequence of mutual ownership. And if you're going to take that risk, you should be rewarded for it. And historically, you were generally rewarded through lower fees. That's less true today. And just so that I don't get accused of picking on big super funds. Vanguard is a mutual fund as well. So if you're invested in VTS or VEU as an Australian investor, you are partially investing in Vanguard, the manager. And so you are exposed to the operating risk of Vanguard. But the underlying assets of the fund, so the shares that are held in VTS, will be held by a trustee, and they're separate. But VTS as a fund, or the US fund in which it's invested, owns some of Vanguard. And it's got an obligation to top up any shortfalls in Vanguard. So it's a consequence of mutual ownership rather than it being super or non-super. So they're small risks.
It's a bug, not a feature, basically.
Yeah, it's a function of the structure that if you want to get the benefits of mutual ownership, which should be lower fees through lower profits to shareholders, it just means you're taking the risk that a shareholder would ordinarily take.
Okay, interesting. And it's a quick little side quest. You know how you get the mutual building society banks and like, oh, we're owned by members, so, you know, all that stuff. I rarely see that the rack rate interest rate that they charge their members extremely more competitive than a Big Four. Yeah.
And a part of that is because they can't raise money as cheaply, they can't borrow as cheaply, they've got lower credit ratings. There's a whole bunch of reasons for it. But it does feel really warm and fuzzy. Yeah. So we're used to mutuals being, you know, farmers markets or bookstores. I mean, I'm sure you would have bought a textbook from the Co-op bookstore in your time, Glenn.
No, but sure.
And so the appeal is that all profits go to members. So therefore your books should be cheaper. And it sort of didn't matter when the Co-op bookstores paid too much money for National Geographic and couldn't compete with Amazon because the books you'd already bought didn't know whether they were bought from there or not, and you could now decide where your next book is going to come from. But with a mutual insurance company or super fund, it does matter because when this risk comes home to roost, it's too late to do anything about it. So now that's not intended to put the fear of God into your listeners, but it's just a point that the really important point is there's a distinction between the trust which holds all of the assets, that's your money as a member, and the operating company. So a bankruptcy of whatever the trustee company that runs House Plus is called, would be largely sheltered from your underlying assets. So that's not a real problem. Does that answer the question, Glenn?
Yeah, I think so. And I was just, I've just written, as we've been talking, I've been writing 1, 2, 3, 4, 5, 6, 7, 8, 9. There's going to be probably over, because life's full of risks, right?
Yep.
Like we take risks every day.
There's no reward without risk.
So we have to understand and mitigate. And what we'll do, we'll take a break. So that's just how the super world works. There's money that gets managed by trustees on the behalf of the member in the super world.
Yep.
The self-managed super fund world, one might say it's the Wild West.
You're on your own.
One might not say that. I have a self-managed super fund myself. But part of my equity investment is in LifeSherpa Invest, which is available for ordinary money and people. And that's a disclosure, it's your company. But so within that, sure, I've got my self-managed super fund, but I'm not really making the investment decisions myself because I believe the portfolio that you have, it's transparent, the fees are reasonable, the returns are decent, long track record, all the stuff, right?
And the assets are held by Link Market Services.
That's right. So we'll have a break, then we'll get back and we'll talk about potential red flags because there is a lot of stuff, we are recording this in July and recently there's been stuff in the news and on the media about failing investments and all that. I don't want to get into the weeds of that because they're on that spectrum, it's, again, I'll repeat, it could be 100% fraud scumbag Or it could be 100% legitimate and the investment falls over.
Yeah.
Now, the reason I say it could be 100% legitimate, Vince, is I've personally invested in startup companies through crowdfunding platforms. That's a legitimate investment.
Yeah.
It's legal. I've put my own money into an unlisted investment in a company. If that company goes under and I lose my deposit that I put in, that's not fraudulent.
I mean, what was that company that Australian Super dropped $1 billion on last year?
Yeah.
Now, $1 billion out of 300 and whatever billion is
Yeah.
not that significant in the scheme of things. But you go back to 2008, there was a lot of ASX 200 companies that fell over. ABC Childcare, City Pacific, MFS, Babcock and Brown, Alco. These were all arguably blue chip companies.
So, and this is why we need to get to one of the red flags as a teaser before I press my button to let everyone know we're having a reset break. It's the diversification. We'll be right back after this.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to retireright.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia, so they can connect with you wherever you are. That's retireright.com.au and click Get Help.
Okay, red flags, diversification. In finishing my comment that because I invested in a startup company with no track record, they've sold their prospectus on a promise. This is what we think we want to do. We want to do this. We want to do that. I can put 5, 10 grand in, 20 grand, whatever that amount is. Now, and this is the whole, when you really look at the risk, if the directors of that company then took that money and bought a holiday with it, well, that sucks to be me. I've just been screwed. But the thing is, I'm not putting 100% of my nest egg into this thing that has got no track record. I can take a punt. I can do that.
Yeah. And that's the downside of some of the self-selection in some of the bigger funds. So House Plus will allow you to punt every cent of your super on international shares.
Is that responsible as a trustee? Don't answer that. Well, but
I think arguably it's not.
No, but this is the thing. The investment allocation, so it could be just an S&P 500 index, for example, or
that's an MSCI index, but broadly.
Yeah. Whatever that is, in its own right, that's fine. That's normal. It will go up and down. But should a member go back to, would that actually be good for their financial life?
Well, obviously it depends on what the rest of their financial life looks like, but it's probably not where you should be punting 100% of your retirement savings. And you talk about diversification. The number of times I've heard.
Should we say hello to Corporate Affairs from Host Plus?
I'm not picking on Host Plus. It's just a useful example because it's
of their
high
member
profile
option.
and they've got a very flexible member option.
Yep.
I'm not suggesting that Host Plus are doing anything nefarious or untoward.
No, and that's it. It's just
it's an example.
It's an example. Yeah, we can have something that's completely
one that
legitimate.
most of your listeners will be familiar with.
We can have something that's completely water is good for you. You drink a lot of it.
It kills you.
But too much of it, you'll die.
So that's a good point that, when it comes to personal finance, if some is good, more isn't always better.
Or as Jerry Seinfeld's joke was when he goes to the doctor with a bad headache or something, it's like, doctor, work out the amount that will kill me and take it off a little bit.
And so, when it comes to diversification, the number of people who go, I'm invested in a global equities fund, let's say VGS as an example, it might invest in 3,500 companies, which might give the appearance of diversification, but actually they're all large companies. It's 100% equities, 100% large companies, 100% Vanguard, and and those companies will broadly behave very similarly. So you're not actually getting that much diversification, even though you've got thousands of names in the portfolio.
Well, so just on this diversification thing, and it's a fascinating topic, within this, you purchase one, I don't know if we need to go there too much, but I'll quickly go for what you say. You could be like, yes, I'm diversified because I've got this ASX 200 ETF with all my money in it.
Yep.
Is 100% Australian shares good for you?
Probably not.
Because when you look at it, diversification, spreading all our risk in different pots is good. But if all the pots are Australian equities, if most of the pots are black holes and banks, if most of the pot or all the pot is in Australian dollars, you've got no diversification there. So I think it's a really good discussion. And so that's probably the number one red flag. These are probably in no particular order of priority, but it's transparency and diversification.
Yeah. So if I just come back to the 165 RSEs. So if you're trying to pick a super fund, you've got to hitch your wagon to one of them. At LifeShopper, we limit our list to the ones that manage $10 billion or more. And that's that amounts to probably 90% of the dollars, but about a quarter of the managers, or less than a quarter of the managers, maybe an eighth of the managers. So that's our first cull. And then you start looking at, well, what's the underlying products look like? What's the pricing look like? What's the service like? What's the track record like? And so having hitched your wagon to a trustee, you now have to make the biggest decision after you've done it. So, and your choice of which trustee will drive the structure of the fund and hence the amount of tax you're going to pay over your lifetime. So big decision.
Yeah.
Next decision is what's my asset allocation? Now that's a fancy way for saying how do I diversify my money across different classes? And asset allocation will drive 90% or more of the underlying returns. That is, it matters more how much of your money is in equities, how much of it's in Australian equities, much more than whether you buy Telstra or BHP. And so getting that next decision right, and that's really a spread across real estate, infrastructure, bonds, gold, cash.
Okay. Can I jump in there?
Sure.
Because this is a really good point. I'm on the cover. Well,
I'm
not on the cover of this one, but I've booked in my photographer in a month's time because I need a few weeks to lose a few kilos. We might be putting a photo of me on the front of Retire Right. But because this could be things, what to ask your financial advisor around the investment selection. What's the asset allocation?
Yep.
Those should be, if they can't answer that, run.
And how does it align with my risk profile?
Yes.
That's number one.
2, ask them what is the underlying investments of each of the allocations segments. So what are the underlying investments with Australian equities? Yep. Then what you could do, you could ask them within that underlying investment, what are the actual companies?
Yes.
Because any financial advisor or fund worth their salt can 100% answer those three things.
That's right.
So they could. So here's an example. So ask me the question, Vince.
Okay.
A little role play.
So what's my asset allocation?
Vince, in your portfolio, we've got 26% in Australian shares.
So what sort of Australian shares?
We've got 2 investments in the Australian shares. One of them is, and we'll call it 50% of the 26% or whatever I said, 30%, is an ETF that invests in the top 200 Australian companies weighted to the index. So it's an index approach. The other option is an active fund, and it could be insert active fund manager here, and they manually select Australian equities, and we can open the product and we can see their top 20 holdings. So that's very transparent, isn't it?
It is.
We've drilled down on, you've recommended me put my $1 million of super into your fund. Okay, you've said 30% of that, or 26% is in Australia. Within that, there are two options. One of them is Australian Equities Index Fund, top 200. The other portion, probably not going to be 50-50 of the 25, but a small overall 5% of the portfolio is in an active small caps company.
Yep.
We use Ausbil, or who do you use?
Ausbil, OC, SGH.
Yep. They've been around for 30 years. They show you the top 50 holdings, or very transparent.
Yep.
Now, if a financial advisor can't drill down on that with the Australian equity allocation, the international equity allocation, at the very least, you need to contact me and I'll give you a new advisor.
Yeah, and in that vein, then if asset allocation is important, then consistency of asset allocation is just as important.
How often do you rebalance?
How often do you rebalance? And many portfolio managers, in particular in the higher profile funds, will have wide ranges of possible. So they might say, we're going to put between 0 and 45% of this allocation into Australian shares.
And is that the strategic asset allocation?
So usually they'll say, our target is 25,
Yep.
but we have a possible range of 0 to 45.
So in the PDS,
That's in the PDS.
you will see words like strategic asset allocation,
Or target,
tactical,
or target. Yep.
Yeah. So basically, because throughout life, the Aussie equities might have a good run and it might increase from 20, but we know it's not going to be more than 35 at any one time.
Yep. And so focusing on the target can be a little dangerous, that you want the target to align with your risk profile. So if you're a balanced investor, your appropriate asset allocation might be 70%. So you want to make sure that your target in whatever you're investing in aligns with that. But if the spread is too large, you really want to look at, are they telling you how they decide where in that range it's going to be? Is it just because they want to be lazy about rebalancing it? Or do they take active positions and say, look, we think the US is going to do better than Australia, therefore we're going to have less in Australia and more in the US. That's called strategic asset.
Yes.
Tactical asset element.
Tactical, yes.
So you start with a strategic asset.
Strategic is this is what we're aiming for.
And then you may move it up and down.
Based on the day-on-day tactics.
At LifeShopper, we're fans of fixed asset allocations, which we reset every quarter, so that you know that if you bought a 70% portfolio, that's what you're going to get. You may or may not get that in someone who does tactical asset allocation. And there's not a lot of evidence that tactical asset allocation adds value sustainably. Clearly, you can win from time to time, just as active managers can win from time to time. But in terms of sustainable differences, your target's what matters and the spread around that. So that's step number 2. And then the underlying that is, what's it actually invested? So if I got my 20% in Australian equities, what's it actually invested in? And index is good.
Any financial advisor that we refer listeners to, I can tell you 1,000,000 times over, they can confidently answer those questions.
Yeah, and that's why on our LifeShopper Invest website,
you show
we
people.
show you what it's invested in.
You could copy Vince's
so you
portfolio
can copy my
yourself
homework if you want. It's not my portfolio, but our investment committee. You can copy our homework. And as I say, if you're going to copy, you should always copy from the smart kid in the class.
So diversification is huge because then if, for example, if the portfolio had overall 5% to an active fund that was a little bit specky and that's why we only got 5% in it, and it fell over, it's not a total flush.
That's right. And the other thing about asset allocation is these names are not necessarily legally defined.
No.
People use. So one of the things to look for, or two things. In terms of the headline 70-30 or 80-20, you need to look at how they're getting to that number. So many of our larger funds reclassify part of their infrastructure and real estate as defensive. We would add that back in terms of our analysis because that's a fairer definition of what's the underlying. And the problem is bigger on the defensive side.
Yeah.
So particularly as you get older, where you're going to have more and more defensive. The difference between fixed interest and credit sounds the same to the man in the street, but they are wildly different things. And many credit funds...
We don't like credit, do we? We don't mind fixed interest.
Yeah, but credit can be very opaque. It's very hard to assess.
Yeah.
And a lot of it's not particularly defensive.
Yeah. Okay, we need to keep moving. Cold calls and pressure.
Yes.
Okay. I got a cold call the other day from a financial company. I'm going to call that number back and see what it...
Easy Solutions Australia. If you require any further information, please contact us at info@easysolutionsOz.com.au.
So that was, and they're calling on mobile numbers. So it's Easy Solutions Australia.
There's quite a lot of them. They advertise on Facebook.
Yeah, so this Easy Solution Australia, right, they called me about a passive income idea. And I said, no, I don't want. But I've just gone to the easysolutionsaustralia.com.au. It's a lead generation business. They're not money people. So their literal job is telemarketing and to line up the ducks to introduce to other companies.
They'd be wood ducks.
That's right. So, for example, the most reputable company in the world, insert whatever that definition is, and we'll make an example. Commonwealth Bank, the biggest bank in Australia at the moment, reputable, you would say. Well, I had a few issues with some ATMs and whatnot. Commonwealth Bank of Australia could engage Easy Solutions Australia and say, we want you to call randoms, ask them these 3 questions and get them to book in at the Commonwealth Bank website.
Yeah.
So that's legitimate in the background. The problem I have is any type of cold call about anything to do with money, power bill, anything, I'm not entertaining it.
Yeah. And
even though if the underlying background is legitimate, my main question maybe is if you're that legitimate, can't you get clients in a more not annoying way?
Yeah. I mean, cold calling is a legitimate marketing technique. It is illegal in Australia to sell financial products in a cold call.
That's right.
So they couldn't sell you a super fund or a managed fund. No, but they could
call me a strategy.
But what they are allowed to do is to book in a call to say, would you like me to send you a PDS, for example?
On a passive income.
Would you like me to book you an appointment with one of our advisors? That's all. Or one of the advising company who's paying us to do this.
Yeah.
All perfectly legit. But the problem with it is that catches you unawares, you're not in the right frame of mind, and it's often accompanied by high-pressure sales tactics. So very few...
Because I would hypothesize, and this is the joke of it all, because Easy Solutions Australia has called me. I had a missed call on the Tuesday, and it's got a marker on my iPhone that it's warning, suspicious calling. So they called back and, I usually don't answer, but I was waiting on a call. I'm like, hello. Oh, I'm like, it's that same flipping number. You go to call them back, for example, their website, you can't call this company. Like, it's purely outbound.
And the thing you should look at is do the people who've called you have a financial services license?
Easy Solutions
and
Australia
I suspect
doesn't.
Easy Solutions. No, they don't need a financial
right.
service license to run a call centre. So I'm not saying they're doing anything wrong, but it means you're being called, you're being promoted to by a lead generation company who's not an advisor. And the advisor who's getting that lead or paying for that lead
Could be the most legitimate person in the world. I'm still not entertaining it.
Yeah. And we see this all the time particularly around the property space. So the number of times you get a call going, would you like to save tax? Well, who's going to say no to that?
Yeah, and that's the whole, we want to talk about passive income. Like, okay, here we go. Yeah. But it's similar. I was walking outside Chemist Warehouse the other day in the mall, and there's two people there from a charity. Mm-hmm. Hey, can we talk to you about charity? And I literally jokingly said to them, I'm like, I don't want to give my money to a charity who needs to pay two people to stand here and collect money from me. It's the job of one person. So the charity outsource things, they're getting a cut of what they raise on the day. So I think a red flag, because number one, if you don't wake up today thinking I want to get better with passive income and that call comes in, you can go, oh, okay, that might get me thinking, but I'll then go and do my own research. Yeah. Use that as a prompt to,
free tip, that doesn't mean Google.
No.
But it is it's a perfectly legitimate tactic for a financial advisor to buy ads on Google, to take out a full page in the Fin Review. Some of our most prestigious financial advisors in the country will take a full page in the Financial Review from time to time. They might buy Google lead ads. Perfectly
and to be fair, I run a lead generation business. If you listen to our content and you learn something from this episode and you never engage ever again, awesome. But if you want to speak to someone who is a trusted advisor, now that's not to say you're going to vibe with their personality. That's not to say that they're the cheapest. That's not to say that they're most expensive. That's not to say that they might not make a mistake, because human errors happen.
Yeah.
It is to say, if you go to my website, I will refer you to someone that I've physically met who I've sent you a client this morning, Vince. I'll talk to you about that. I literally just want anyone who listens to our stuff not to get taken for a ride.
Yeah. And it is a difficult buying decision, because it's one of these things. It's like a doctor. There's a huge asymmetry in information. So when I go to my cardiologist, I really have to accept that their diagnosis is in their best judgment. I quite like an old cardiologist from that sense. So I don't really want a 35-year-old cardiologist. I want someone who's been doing it for a while.
That's interesting.
And I
don't like my cardiologist is dead either.
No, you don't have a dead one, and but you do want someone who's been around the traps. And when it comes to investing, if someone hasn't lived through a serious downturn, do they really understand investing? On the other hand, you want an advisor who's going to be around for long enough. So you can't have 100% of both. What you want effectively is an experienced advisor working in a business that will survive them, so that there's a structure behind them, there's a team behind them, and when they retire, there's someone coming along behind them. So where was I going with that?
I don't know, but cardiologist,
dead. But the point being that you need to – there is an element of trust in this decision. So you need to look for the flags of trust.
Yeah, green flags.
So what are the green flags and absence of red flags? Traditionally, this was largely done by referrals. As the number of advisors shrinks and the number of people who need advice grows, that's becoming harder to do, because there's lots of people now who have money that didn't have it and don't move in circles with other people who have advisors. The golf club was the classic place for referrals, and so that doesn't happen anymore.
Some red flags will camp here very briefly, because it does tie into the diversification thing. a third-party custodian. So if I go to Glenn James as a financial advisor, I'm not saying, hi, I'm Glenn James, I'm your financial advisor. By the way, we want you to set up a self-managed super fund, and we're going to put the lion's share of your money into the Glenn James investment fund, and I personally select the best investments within that. And
that was a big problem 15, 20 years ago, where you had most advisors were licensed through what were called vertically integrated businesses, where they had an advice business, they had a funds management business, they had an insurance business, they had a superannuation product, and you were very likely to get recommended in-house products. That's becoming much less of an issue, but certainly if you're getting in-house product, you should be asking questions. That's not to say that all in-house product is bad, but you do need to be aware of it. And most losses have occurred where there's a concentration of ownership of the product. So most times where you see a failure of a product, it's largely associated with the relationships around that sale product. So, so at LifeShopper we use all of the big fund managers, largely index managers, so Vanguard, BlackRock, State Street, all very reputable brand names, none of whom we're related to. And assets are generally held by a third-party custodian.
Question. I think a red flag is potentially when they hero returns.
Yes.
And we can beat X, Y, Z.
That's right.
Now, there could be by the way, factually speaking, what we've recommended here, if we back tested it across Australian Super, it is actually 1.5% more.
Yep.
Another trick, make sure they're comparing the same asset allocation.
Yes. That's
not saying, our fund did better, because it's higher risk.
Yes.
So
that's
we're not interested in someone putting pressure on, heroing that we will get you 13% a year guaranteed. We don't like the G word.
That's right. And, that's a natural human thing, though. So humans naturally want to be able to make more money with less risk. So if you hear that message, it's an attractive message.
Yeah.
But it's also unrealistic. That's not how the real world works. That if you want more return, you generally have to take more risk. And so there is a need for skepticism. So if someone's saying, I can get you X%, especially if it's followed by the word guaranteed or certain, then, and it's, if you want a guarantee, it's pretty hard to get more than the cash rate. So if someone's guaranteeing you more than 5, there's a flaw somewhere. But it is a natural human reaction to go, I want more for less. And that's not how the world works.
And here's another red flag, everyone. When you're going to a financial advisor or a property coach, you can go to John Pigeon, who hosts our property show, and get coached of how to buy an investment property to build wealth for the future, right? All legal, all good. From your own personality thing, don't go to a professional with their solution to make all your problems disappear and catch up the 15 years where I haven't put money into super.
That's right.
Because that's when greed can walk in the door. Yeah. And that's when something that follows greed is stupidity. Then after stupidity is broke.
That's a good one, yeah. I mean, people often, when they think about getting an advisor, they think about, is this advisor going to beat the market? And that's completely the wrong question to be asking. And what I will quite clearly say, and you've probably heard me say this on this podcast many times, that the market delivers the returns. My job as your advisor is to make sure it ends up in your pocket. And the reasons it won't end up in your pocket is that you've got an asset allocation that doesn't align with your risk, and if you run the risk of hitting the sell button inappropriately, you pay too much taxes, you pay too much fees, or your behaviour gets in the way. And all of those things are what an advisor is doing for you. So when I recommend that you put 20% in Australian equities and that you should buy the Vanguard Australian Share Fund, well, VAS doesn't know whether I recommended it or your cat picked it out by pissing on the newspaper. It will do what it does, and it will do what the Australian market does, because that's what it's designed to do.
Yeah, as a general rule, and for my life, I'm okay with market returns.
Yeah, but I think that the thing about market returns, though, and where you do get...
They always perform less than the market after fees.
that it's the blend that creates the plus. So whilst VAS doesn't know whether I recommend it or you chose it, or you threw a dart at the wall, the way it works with the small cap Australian fund that we put with it and the US investment and the global and the emerging markets and the real estate and the infrastructure and the gold and the bonds, that's where the excess return comes from. And that takes years of experience to do. And it's not just about lining up the ETFs and going, which one gave me the best return?
Yeah, and we don't, when we're investing, we don't look at the the magazines with here's the best funds the last month or the last year to date. We don't care what the last year did, and we're not making an investment decision based on the previous returns. Yep. I will say, we've got to round this out, Vince. We've talked about the diversification or lack of returns. We're not heroing them or shatting on other funds. Low fee doesn't equal best.
Correct. And often low fee is a function of asset allocation. So large cap equity, so that's large companies. So in Australia, the Vanguard Australian Share Fund is 0.04.
Yeah, 0.04.
0.7. But it's close to zero.
They call that free.
Yeah, it is vanishing close to zero. An S&P 500 US large cap fund should be that same sort of number. But that doesn't mean that you should just buy Australian large companies and US large companies because they're cheap. You actually need some infrastructure and some real estate, and they might cost you 0.5 because they're just more expensive to manage. But the mix of those four things will give you a better answer. So you've got to... Price only matters when you're getting what you need. And by eliminating the expensive stuff, you're lowering the price, but you're not getting what you need. And so there is a balance. Now, fees matter. They matter a lot. But they only matter when you're getting what you need. And by saying large cap equities are cheaper, therefore that's what I should invest in, is just a nonsense.
And just on that, Vince, there was a popular book, Barefoot Investor.
Second best-selling book in Australia after the Bible.
After the Bible. There was, I don't know if I'll use the word recommendation, but there was a vibe to move your super
I think I'd call it a recommendation. Okay. He did have a license at the time, so it's probably okay.
Move your super to the Host Plus index balanced option because it's the cheapest super fund in Australia.
And it still is.
If we look from now in July 2025, that fund did 7.31%. Pretty good.
On average. For 10 years.
10 years.
Yep.
Now, if you went to the balanced fund that is more expensive, which, old mate was like, go to the cheapest fund in Australia because fees obviously matter. Yes and amen, fees matter. The balanced fund, after fees and taxes, did 7.94%. That's 0.63%, 0.5% higher performance than the cheaper one. So if I paid more, I would have got a higher return. Probably a smoother ride.
Yep. Almost certainly lower volatility.
So I'm 150,000% not shatting on that book, not shatting on him. I'm pointing out fact that if you purchase the cheapest investment option, you are financially worse off over the last 10 years.
Although the interesting thing about that anecdote that you just told is that if you talk to Host Plus, so Sam Cecilia is the face of Host Plus, he will tell you, and in fact he told the Royal Commission this, so I'm not telling anything out of school, that book resulted in huge inflows for Host Plus.
I went into the wrong return.
But they actually the vast bulk of it went into the balanced fund, which is the better asset.
Yeah.
So by dumb luck or marketing on the part of Host Plus.
But that also is a really good example to speaking to the need of financial advice. Like you read a book, listen to a podcast, I'll go and do it myself, and I'll do it myself and I stuff it.
Yeah. Now that stuffing gave you the better answer on that occasion.
On that occasion.
But it's just as likely to work against you.
And I think the crescendo that I want to finish on, there's a lot of there's an individual that's spending a lot of money on Facebook ads at the moment and, very anti-bank and paying off your mortgage fast and all this stuff. And I think you were telling me that you went to or you had a member do one of their online seminars. And
so one of our members that we did some financial advice for around their super about 6 months ago, it was cold called.
From the same individual's company?
I think so. I don't know, so I'm not going to say. But they got cold called and got talked into buying an off-the-plan property in Melbourne and set up a self-managed super fund.
Was it an apartment by chance?
It was a high-rise apartment off the plan. And so that would have resulted in a project marketing fee of potentially...
That's a 30 grand deal for that company.
Or more. They would set up a self-managed super fund. And so the first we knew about it was we got the rollover request, which obviously we checked from a rollover request to a self-managed super fund. You go, high risk, let's call the person and go. And so she told me that that's how she done it. She was happy with the decision. But
I'm sure she was.
Today.
She was going to make lots of money.
But the proof of that pudding is in.
So what the individual has done has been sold the dream that we can get you a better return and you can have a property. But in one strike of the pen, they're less diversified, higher risk, more complexity, and what could go wrong?
What could possibly go wrong?
So for me, if there's a push for a self-managed super fund, and
that's a bit of a red flag.
That is the biggest red flag on the planet, unless there are some very complex estate planning issues. There could be significant balances. There could be a commercial property for a business, all that stuff. But for the main, so if we swing it back around full circle, the question at Angela, if she went to an advisor and said, we've got this self-managed super fund, commercial property, we need some advice, there would want to be a reason that would literally explode my mind as to why the self-managed super fund should be kept open.
Yeah, so if you've got rid of, the main reason why self-managed super funds make sense in today's environment is if you want to invest in real estate, and that's quite a big deal for doctors owning their surgery, small businesses owning their warehouse,
podcasters owning studios.
In my old business, we had a lot of self-managed super funds which had taxi plates. Now, back then, that was a big deal. Today, I don't think they're worth very much. But that was a structure that you could do that. Today, a wrap account will give you almost everything you need unless you want to invest in real estate or private company shares. And so the need for a self-managed super fund and all the complexity that goes with it.
And we will do a dedicated episode, I'll get Liam or someone in to do
Shorty.
it. Yeah, from your country.
Yep.
Ireland.
He's from a slightly different part of the country.
Unless there's some type of, I don't know enough about the accounting losses or something in there that you want to keep it open to.
Yeah.
All that stuff. Like,
but if you've just sold a commercial property that went okay, you probably now net tax, you'll have consumed any losses you might have had.
Yeah.
So there are conceivable reasons why you should, but as a general rule,
what you can get for the normal course.
and of course most people
don't need a
who
self-managed
have a
fund.
commercial property and now getting to sell it is probably because they've sold the underlying business,
Yeah.
or they want to retire
And they
and
need
don't
some
need the property
liquidity.
anymore.
Yeah.
So that would be a good reason to move to.
And it'll be actually for Angela potentially in her family situation, if she's got a spousal partner, I'm not sure. The end result, once the commercial property is sold and it's fast forward and we've invested it in a balanced portfolio or whatever that is, it will be more diversified than what it was.
Oh, yeah.
It will actually be safer than one commercial property.
Yep. And of course, by being in the normal superannuation system, you get access to all of the compensation schemes that go with it, which you don't get in a self-managed super fund. Now, the other red flag for me, which we haven't got to yet, I don't know if you got to the end of your list, but the big one for me is the sophisticated investor pitch. So if the person or advisor who's trying to convince you to sign I'm a sophisticated investor option because you can get access to investments you couldn't otherwise get, that's a red flag, because by signing that document, you may feel good that you're a sophisticated investor, but what you've just done is sign away all your consumer protections. So that is not there are occasional reasons why it might make sense, but if you're investing less than $2 or $3 million, it makes very little sense.
I had a listener of our show, and I will keep these very high level. I've talked about it, like they won Powerball, so $30 million. And they contacted me and wanted a recommendation, and they went to a private bank to, get some advice. And it just, and they said, I always do this. And so I referred them to Martin, who hosts this show sometimes. And so they've been looked after by Martin. And the advantage for this couple with their $30 million, there are inherent protections for that wealth with Martin's PI, all the due diligence. They're not treated as a sophisticated investor.
Yeah. And
because if they went with a private bank down the road and we started, all right, let's put $500K in this little project here and this, that's outside of the probably PI insurance schemes, outside of general protections.
Yeah.
So if you do something yourself and you stuff it, guess what? You're stuffed. If you go to an advisor and they stuff it, guess what?
You got PI.
You might have some PI insurance. They might go, yeah, sorry, we accidentally did that. Here's $20,000. We'll make it up for you. I don't know.
Yep. And the other thing about the big investment banks, having worked for one, the private client base is distribution for product. Yeah. So when they're underwriting an IPO or they're doing an issue for someone,
they knock on the door and say, hey, we need
okay,
$500,000.
Okay, guys, go find your clients and see who's going to be the stuffy for this deal. And so that's probably, so the high pressure, emphasis on returns, downplaying risk, guarantees.
Push for self-managed super fund.
Push to self-managed super fund.
Shatting on other funds in a big way, lack of diversification, off-the-plan purchases.
Yep.
Cheapest is not always best.
And anything that is sold on its tax benefits.
Yeah. And cold calls, all that. And what I might do, everyone, I'll put this all these points in a blog on the Retire Right website, and we will or a downloadable PDF or something that you can just have a bit of a checklist. So when you go and see a financial advisor, you've got that in front of you, and at least you can cross-check. I wrote down, just because you haven't heard of it doesn't mean it's not legitimate.
Yes.
We get people in the Facebook group all the time say, I was referred to a financial advisor. They recommended a Hub24 account or a net wealth account. I'm freaking out. I write, yeah, it's fine. Like, because it's fine.
It is. As a platform.
As a platform. This is no comment, like it's fine as in not a scam. Now, if you, for example, get a call from, what was it, Easy Solutions Australia or whatever, and they've talked you into some passive income
Stuffmysuper.com.au
and all that stuff, and you go, all right, whatever, I'll buy it, and you end up there and you get a recommendation, pop it in the Facebook group and say, hey, I've just been recommended the Master Shield Trust. Anyone had an experience?
Yeah.
Now, it's grain of salt stuff. One person could have been recommended the most normal legal thing in the world, and someone says, nah, it's rubbish because they had a bad experience and whatever. But you look for trends and themes.
Yeah.
So
and
Google.
it's a good point. Yeah, good point you just made. That the distinction between I was recommended Hub24 and I was recommended the Shield Master Trust. One's an actual product that you can look at returns and look at what's actually in it. Hub24 or Net Wealth are just platforms, and what matters is what it's invested in. So telling me I was recommended Hub24 tells me nothing.
No.
Other than structure.
Like if you know, dig deeper and someone, an advisor has recommended you Hub24, nothing wrong with that. It's fine. It's legal. But in the next breath, you said, oh, and they recommended 80% to the Bitcoin ETF. Yeah. That's when I have a problem.
Yes, that's right.
So this is why we are here. If you want to continue this conversation in the Facebook group, just put I listened to Glenn and Vince for over an hour. And if you want any follow-up questions, and hello to corporate affairs at Host Plus. You know,
please contact my marketing agent.
Well,
here.
But this is it. Like, I just want to be real and talk facts. And some of the stuff we've talked about today, like people might say, "Oh, you're just jealous," and all that shatting on the Barefoot Investor book. It's changed millions of lives. I'm just saying the facts are cheapest super fund isn't always best.
Yeah, great book as long as you ignore the stuff about super and insurance.
Agree.
And budgeting.
Yeah. We will leave it there. My name is Glenn James. This is Vincent Scully, and we've been cancelled. Thanks for listening and watching. We'll see you soon. Bye.
Bye for now.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive, Pty Ltd, and Glenn James are authorised representatives of Money Sherpa, Pty Ltd, which holds Financial Services Licence 451289. Martin McGrath, Financial Edge Group, and its employed financial advisors are authorised representatives of Synchron Advice, AFSL 243313. Opinions or comments from any guest on the podcast are theirs, and not those of the hosts, the publisher, or their respective licence holders.